Good day once again. This is the third part of our discussions involving interest rates. Make sure to watch parts one and two of this particular series. Starting with characteristics of business cycles. Business cycles would normally be shown as graphical illustrations that would also show the start or introduction of the business up to such time that it will grow and reach maturity and would eventually decline. So for that particular illustration for business cycles, it's also true for the economy and recession, in which that's already the start of decline of productivity of the economy. Recessions or expansions look similar. That is, there seems to be consistent statistical relationships between GDP and the behavior of other economic variables. Why is that? If, for example, there is recession, there is lower GDP. And if there is expansion or prosperity, there would be, of course, higher GDP. And that's the reason that we can say that there is correlation or relationship of two variables, because one would increase and other would also increase. And if one would decrease, the other would also decrease. All right? With decreased recession, expansion increase. And here are terms at the bottom: correlation, in which we have pro-cyclical, and that's true for what we've mentioned a while ago, wherein the increase of one will have an impact of increase to the other or decrease. But if it's the opposite, wherein there are, for example, certain economies or businesses that would grow despite the recession that is happening in the economy, just like what happened in the pandemic, wherein there are some sectors who are enjoying much profits or that are enjoying much profits despite the recession or lowering of the GDP in the economy. That's counter-cyclical, or the opposite of what is the usual thing that is happening rather. Timing is leading, coincident, or lagging. So if in economics, leading would be those at the forefront. Coincident would be just because of riding with the situation. This is increasing because the other is increasing. So they are coincident. And lagging is the opposite of leading, at the back, or let's say just next to those in the front. And relative volatility, let us take note that normally these are estimates or forecasts that are to be made. And that's why we have relative aspects, or mean to say we are not being able to determine the impact of these at 100%. There would be some margins, and these margins are basically the errors that we talk about in statistics or in research. Now, we have the interest rates versus GDP as shown here. So yellow would be the one-year treasury bill and the red would be the GDP. Nominal interest rates tend to be pro-cyclical and lagging. So pro-cyclical because if, for example, our GDP is increasing and so is our treasury bill. So the two would be in same direction or movement. While lagging would be that the others could be behind or at the back. And that's also true about that. So anyway, these are again estimates. Whereas for money though, interest rates tend to be negatively correlated with changes in money, especially in the short run. So if we have changes in the money supply, so money would increase or decrease. If, for example, there is really large available money in the economy, so in that case, the companies and especially our government agencies would control, especially the Bangko Sentral ng Pilipinas would control the situation. So how is that to be controlled? Normally, if ever there is really big money supply in the economy and with lesser goods available, that would create inflationary effects, or there would be inflation. And so the monetary policy would be that the companies will be provided, or people will be provided with higher interest rates should they get loans, because they will not be motivated much more to borrow money from banks or other financial institutions with higher interest rates. And that would limit the money to be supplied to the businesses and people or individuals. However, well, this is on another situation, or and taxes can also form part with the solution of this. So with higher available money supply in the economy or disposable income in the economy, the BIR, which is tasked with the collection, but of course, what agency will be in task overall for our taxation policies under fiscal policies? We have our Department of Finance for that. Anyway, but based also on tax laws to be passed by the legislative branch of our government. So that's also another field or area already that we are discussing, but closely related. So higher taxes could be imposed so that people would have lower disposable income to counter inflationary effects. But anyway, that's again fiscal policy. This is monetary policy. With higher interest rates, so people would have lesser money supply later on, since they will not be borrowing more or much money with higher interest rates. And again, there's opposing effect. Higher interest rates, so lesser money supply. All right. And then this one, this is our, for a while, review. Nominal versus real interest rates. With higher inflationary effects and rates available, our real interest rates would be lower. So we have basically our formula. Let's say a $1,000 investment at a 10% annual interest rate will pay out $1,100 in 1 year. So to compute the nominal return, that would be 1,100 minus 1,000 with a $100 interest divided by the principal is 0.10 or 10%. All right, so we can also do this 1.10 minus 1 to get I of 0.10 or 10%. Now, what about the real interest rate though? So to get, for example, with this sample problem, we must divide by the price level, current and future. So with that, anyway, it's not shown here as to how much really is the inflation rate, but basically that's just going to be the nominal rate to be added with 1. So 1 plus I divided by 1 plus inflation rate. Then we deduct 1 to get the R. Hopefully there is an example here. Yeah, there it is. So 1.10, knowing 10% is our nominal interest rate. 1.10 divided by 1.05 equals 1.048. Minus 1 equals 0.048 or 4.8%. You can actually double check with that with your calculators, and you should be pausing this part here so that you can verify. So it's really 4.76%. It's just rounded off this way. All right, so that's also how we get it. 4.76% if 2 decimal places. This is just 1 decimal place. Now, this is also another method, which is just an approximation though. This is not a substitute of the former formula, which is exact, in which we can just simply deduct from our nominal interest rate the inflation rate. So nominal interest rate is 10% minus 5% equals 5% estimated or approximated real interest rate, which is close to 4.76% or 4.8%. Then this is a particular graph that shows the real interest rate or rates from 1975 to 1985. So 10 years duration and very fluctuative. We can see that, but the trend is increasing. That's a good thing. Why would anyone accept a negative real rate of return? Well, we don't have a choice if, for example, our inflation rates really are that high. despite that we are earning. So nominal interest rate is lower than the inflation rate. That would result to negative real rate of return. And in that sense, that's why nominal rates are never zero or negative, but the real rate of return can be zero or negative. And this one is interesting, ex ante versus ex post. The word ex denotes after, correct? And ante, which means before, post, which means after also. So it's like after before and after. But really, what we mean is that ex ante, before we are able to determine the actual situation, then there's the interest rate. Ex ante real interest rates are the rates investors expect based on anticipated inflation rates. Just anticipating certain factors or situations to happen, still estimates, and then that's before the actual occurrences. But ex post would be the real interest rates, in which the rates investors actually receive after the fact has been established. The difference also between the two depends on the accuracy of inflationary expectations. So if expectations are not that great, ex ante would be the much that would be affected, because ex post would be after the fact has been received. And here are some graphs showing expected, actual, inflation expectations, and the real rate of the return with that. So expected is at the red again. The actual is very dramatic also, normally at the top of the red, but could go down. And with that, the real rate would be going lower, or the lowest, if ever, our inflationary rates would be at the highest, especially for the actual ones. Okay, inflation expectations and real returns. For expectations, they tend to be quite persistent. That is, investors don't seem to update to new information. So what we expect, generally speaking, would be the same all throughout. Therefore, real interest rates also have a high degree of persistence, or they tend to be constant along the way. As a general rule, there could be exceptions to the rule. And that will be the end of our presentation. Thank you very much for listening, and thank you, and God bless us all.